Hello everyone and welcome to our corporate finance course. In this video, we will dive into the exciting world of finance, exploring essential concepts such as risk aversion, present value, and net present value. So let's get started with an introduction to corporate finance. Today on our agenda, we have the following three topics: risk aversion, present value, and net present value. So let's dive in. As an overview, it makes sense to describe what actually corporate finance is. Corporate finance is all about making strategic financial decisions that maximize shareholder value. Whether it's raising capital, investing in new projects, or managing risks, companies have to navigate a complex financial landscape. One of the key pillars of corporate finance is risk management. By assessing and managing risks effectively, businesses can secure their financial success and ensure robust investment decisions. Now let's talk about risk aversion. Imagine you have two investment options. One promises a certain return of 5% annually, and the other might give you a higher return of 10%, but comes with a higher uncertainty. Which one would you choose? A risk-averse investor tends to prefer the first option with a certain return, while risk takers might opt for a higher yield but riskier investment. Therefore, risk-averse investor prefers certainty over risk. As an example for risk aversion, let's consider Sarah, who is an investor having 10,000 to invest for the next 5 years. She is considering two investment options. Option A offers a certain 5% return, while option B promises a potentially higher 10% return. However, option B is riskier, and there is a 50% chance that Sarah may lose 10% of her investment. So, what should Sarah choose? Sarah's decision will depend on her risk tolerance or risk aversion. If she is risk averse and wants to protect her capital, she might prefer option A, which provides a certain and lower return. On the other hand, if Sarah is willing to take on more risk for the possibility of highest returns, she might choose option B. The risk-return trade-off shows that investors expect higher returns for bearing higher risk. It's crucial for Sarah to carefully evaluate her risk appetite and investment goals before making a decision. A good way to conceptualize the risk aversion is used on the graph. And as you can see here, it's the most common graph for risk aversion. On the x-axis, we have the wealth. On the y-axis, we have the utility. As you can imagine, the wealth and the utility have positive correlation with one another, so the utility increases with wealth for most people. Now we have several options. Option A, B, and C. Option B depicts the risk-neutral investor. For such an investor, the wealth and utility increase in equal amounts or increase proportionally. Option A depicts the investor with increasing returns to scale utility function. Therefore, for high investment grade, the utility increases much more than at the beginning. Option C exactly depicts the risk-averse investor because for him, at higher levels of wealth, he prefers more certainty, so the utility increases much less, so he has decreasing returns to scale for utility. Affect your portfolio performance. Market risk arises from fluctuations in market prices, like the volatility you often see in the stock market. Credit risk is the risk of borrowers or counterparties defaulting on their obligations. Liquidity risk, on the other hand, is the chance of not being able to sell an asset quickly without significant price discounts. Lastly, operational risk results from the internal processes, systems, and human errors. You can come up with other types of risks on your own, such as the risks of catastrophes. To illustrate the concept of risk, I provide an example with Mark's stock market experience. It's a classical financial risk that most people discuss in finance. Mark is an investor who decided to invest 5,000 in a technology company stock. After a few months, the stock market experienced a sharp downturn, causing the value of the Mark's investment to drop significantly. So, what main risk does Mark face? What's the answer to that? Mark's experience highlights the presence of market risk in his investment. Market risk is caused by external factors beyond investors' control, such as economic conditions and market sentiment. For example, there was a high market risk during the COVID-19 lockdown. In this case, the decline of the stock market affected the value of Mark's investment. It emphasizes the importance of diversification and risk management strategies to protect investments against market fluctuations. Investors should be aware of market risks involved in their investment decisions and carefully consider their risk tolerance and investment horizon. We are talking quite a lot about risks. Now, how could we measure one? Two essential metrics in finance to measure it are standard deviation and beta. Standard deviation quantifies the dispersion of investment returns around their average. On the other hand, beta measures the asset sensitivity to overall market movements. For example, a beta of 1 means that the asset moves in line with the market, while beta greater than 1 indicates a higher volatility than the market. Beta below 1 correspondingly indicates that the asset correlates less with the market. Beta below 0 indicates that the asset and the market have opposite directions. So when the market goes up, the asset tends to go down, and so on. This statistical measure helps us to conceptualize the diversification of risk and to optimize in terms of the hedging of risks. It's important for our future discussions. As an example, let's discuss the beta of a tech company stock. ABC's tech company is a technology sector company. An investor is considering investing in ABC's tech stock. The investor wants to assess the stock's risk relative to the overall market. Beta is a useful measure to understand how ABC's tech stock behaves concerning market movements. If stock has a beta of 1, it moves in line with the market. A beta greater than 1 indicates a higher volatility than the market, while a beta less than 1 indicates lower volatility. The beta provides valuable information for investors to gauge the stock sensitivity to market movements and helps them to make informed decisions based on their risk preferences. As already mentioned, the risk-return profile of an investment plays a crucial role. All investors want to find the right balance between risk and return. That's why this diagram really comes in play. That's where the risk and return profile comes in. It's like a math plotting a risk measured by standard deviation, which we discussed previously, against the expected return. Depending on your risk tolerance and investment goals, you might prefer investments with higher or lower risk. Remember, greater returns often come with greater risks, as the diagram indicates. As an example, let's discuss diversified portfolio versus high-risk investment. And now we have our investor, Emily, who is considering two investment options. Option A is a diversified portfolio of stocks and bonds with moderate returns, while option B is a high-risk investment with the potential for significant returns. Intuitively, one can suggest that risk-averse investor would opt for option A. What would Emily do in this situation? The answer is, as the graph on the next page shows, the risk-return trade-off states that option A should provide the return which is lower. However, it would come at a lower risk. So Emily, if she is a risk-averse, should choose option A. Alternatively, she should opt for option B if she is more risk-seeking, which is an investment in option B, which provides higher return, however, which comes at a higher risk. Concept which is important in finance is the concept of present value. It's based on the time value of money, which means that a dollar today is worth more than a dollar tomorrow. To calculate PV, we can use the simple formula of the present value equals to the future value divided by 1 plus the return in percent, and all of this expression raised to the power of the time in which the investment takes place. For example, we can use this formula to calculate the present value of 1,000 to be received in 3 years at the discount rate of 5%. As one can imagine, if we receive 1,000 in 3 years, we take 1,000 divided by 1 plus 0.05 and raise it to the power of 3. That's how one can obtain the PV quite easily. Now we can discuss using an example the concept of present value in action. For example, let's take John, who is considering investing 50,000 in a small business venture. This business venture is going to generate 1,000 per year for 3 years. The rate of return for the next 3 years is 5%. Using this information, one can calculate the total amount of each future value discounted back using the formula as provided in the answer below. The present value, therefore, would equal to $2,722.8. This means that at 5% discount rate, the 50,000 investment is expected to generate an equivalent value of $2,722.8 today. The concept of time value of money is of ultimate importance in finance. The time value of money is a crucial concept for loans as well as for investments. Let's say you borrowed 10,000 and you want to know the total amount you'll need to repay. The time value of money comes into play here as we discount future cash flows to their present value. It helps us to understand the real cost of borrowing or the true value of the investment. To understand the importance of the concept of the time value of money, we can demonstrate it in another context, such as loan payments. Let's take Jessica, who takes out a loan for which she has to pay 10,000 each year, and the loan is expected to be repaid in 5 years. The interest rate is 6%, and to calculate the present value of the loan, one can again use the present value formula. So for each year, we discount the 10,000 recurring payment using a 6% discount rate and sum up all of the payments together. When we sum up all payments together, we get the present value of the loan of $41,021.25. Therefore, by using this method, Jessica can easily calculate back how much loan she has to pay in 5 years. The final concept for our lecture today is the net present value. The net present value is a powerful tool for evaluating investment opportunities. It measures the difference between the present value of future inflows and outflows for a project. A positive NPV, or net present value, indicates a potentially profitable investment, while a negative NPV suggests the project might not generate sufficient returns to cover the initial investment or to cover the initial cost of the investment. As you can see on the formula below, to calculate the NPV, one can use simply the present value formula from before minus the initial investment that one makes. So the concept is a bit more complicated than present value. One can illustrate the concept of NPV in practice using, again, an example of the launch of a new product. For example, company XYZ is considering launching a new product line. The project requires then $50,000 of initial investment. The expected cash flows for the next 3 years are as follows. Year 1, 20,000, year 2, 25,000, year 3, 30,000. To calculate NPV, one can discount all of these cash flows back using an 8% discount rate and minus, in the end, 50,000, which is the value of the initial investment. How much would one get? One gets $16,751.26 as an NPV. Therefore, the NPV is positive, which means that the project is expected to generate a positive return, making it a potentially profitable investment. Therefore, company XYZ should totally go for this investment. We've covered a wide range of topics in corporate finance, from risk aversion to NPV and beyond. Understanding these concepts is crucial for making informed financial decisions and maximizing shareholder value. Thank you for joining our corporate finance course, and I hope you found this journey into finance both enlightening and enjoyable. If you have any questions, feel free to leave them in the comments below. Until next time, I'll post more videos in the future. It was just an introductory video. Thank you. Happy investing!